There's a small window every year when a handful of quick moves can quietly cut your tax bill by thousands of dollars, and it slams shut at midnight on December 31st. Most retirees sail right past it, never knowing they left thousands on the table. Today, 5 year-end money moves each with a deadline, a real number, and an honest note on who it actually helps. Save this one. 5 moves. Harvest gains at 0% tax. Handle your required withdrawal the smart way. Beat the standard deduction. Top off your accounts and dodge a penalty. And convert to a Roth while it's cheap. Each one can save real money, and almost all of them must be done before the ball drops on December 31st. Miss the date? Miss the savings. Here's why the urgency is real. Unlike some financial moves you can make anytime, most of these are strictly calendar year. Once January 1st arrives, the door is closed for the whole year, and you've permanently lost that year's opportunity. Taxes work on a January to December clock, and December 31st is the buzzer. That deadline is exactly why this video exists now. And these aren't vague tips. We're talking specific, verified 2026 numbers, a $32,200 standard deduction, a $111,000 charitable move, a 0% tax bracket you can exploit, real levers with real dollar figures that a lot of retirees simply don't know exist. Let me walk you through each one plainly. Meet Bill and Carol, 68 and 66, sitting down in mid-December to run their year-end checklist. By the end of this video, they'll have worked through all 5 moves, figured out which ones fit them, and quietly saved themselves thousands on next April's tax bill, all before New Year's. Let's run the checklist right alongside them. One honest note up front. These are genuine, powerful levers, but they're situational. Not every move fits every person. The real value isn't blindly doing all 5, it's knowing which ones apply to you. So for each move, I'll tell you exactly who it helps and who can skip it. This is a checklist, not a set of commands. And it's not tax advice. A good CPA can size these to your life. So here's the deal: 5 moves. 1 hard deadline, potentially thousands of dollars saved. Grab a pen or just save this video, because you'll want to run through this checklist every December from now on. It's the kind of quiet, unglamorous work that quietly makes retirees richer. Let's start with the first move, and it might be the most satisfying of all. Here's the checklist: harvest gains at 0%. Handle your required withdrawal and the charity move. Beat the standard deduction, top off accounts and fix your withholding, and convert to a Roth in a low-income year. 5 moves before December 31st. Let's knock them out one by one. Welcome back to Faceless Millionaire, where we hand you the specific, deadline-driven moves that quietly build and protect wealth. This year-end checklist is one to bookmark and reuse every December. If it helps, like the video and subscribe so it comes back around next year. And comment which of these 5 have you actually done before. Be honest. Let's run the list. Quick disclaimer. I'm not a tax advisor, and this is educational. Every figure here is specific to tax year 2026 and changes each year, and these moves are situational. A CPA can size them to your actual income and accounts. Nothing here is a personal recommendation. With that said, let's get to move number 1. It's a genuine free lunch for the right person. Move 1: tax gain harvesting in the 0% bracket. This one sounds too good to be true the first time you hear it, but I promise it's completely real and completely legal. Here's the headline in the right situation. You can sell your winning investments, the ones that have grown a lot, pay literally 0 federal tax on that profit, and reset your cost basis higher in the process, all above board, and all before December 31st. Most people assume that selling a big winner always means a tax bill, and for higher earners it does. But for moderate income retirees, there's a 0% zone where capital gains simply aren't taxed at all, and shockingly few people take advantage of it. It's one of the best kept secrets in the entire tax code, hiding in plain sight, and it's especially valuable for retirees in those early, lower income years. It's the mirror image of the tax loss harvesting that gets all the attention. This is tax gain harvesting, and in the 0% bracket, it's arguably even better because you're locking in gains and resetting basis without paying anything. Let me show you exactly how it works, and the one line you must not cross. Here's the foundation. In 2026, long-term capital gains are taxed at 0% completely tax-free as long as your total taxable income stays under about $49,000 if you're single, or $99,000 married filing jointly. Below that line, your investment gains cost you nothing in federal tax. Many retirees, especially in their early years, live right in that zone. So here's the move. If your income is under that ceiling, you deliberately sell some of your most appreciated stocks or funds, realizing the gain on purpose. Because you're in the 0% bracket, you pay no federal tax on that gain. You just harvested a profit, tax-free. But the real magic isn't just the free gain, it's what it does to your future taxes. Here's the genuinely clever part, the piece that makes this more than a one-time trick. Right after you sell your appreciated shares, you can immediately buy the very same investment right back. Now you might be thinking, wait, isn't that a wash sale? No, and this is a crucial detail. The wash sale rule only applies to losses, to stop people from harvesting fake tax losses. There's no wash sale rule on gains at all. So selling for a gain and immediately rebuying is completely allowed. And look what you've accomplished. You now own the same shares you started with, but with a brand new, higher cost basis, the price you just rebought at. You've permanently raised your basis, for free, without paying a dime of tax, because you were in the 0% bracket. And a higher basis means far less taxable gain in the future, when you eventually sell for real, at a time when your income might be higher, and those gains would actually be taxed. So you've quietly shifted a chunk of future taxable gain into the tax-free zone today. Do this in multiple low-income years, and you can walk a large amount of gains through the 0% bracket over time, permanently erasing tax you'd otherwise owe. It's one of the few genuinely free lunches in investing. And here's the deadline. This only counts for the current tax year if the trade settles by December 31st. The 0% bracket resets every January 1st, and any room you didn't use is gone forever. So this is a use it or lose it opportunity every single year. Each December, you check if you have room under the ceiling, and if you do, you harvest. Don't leave that free room unused. Now the honest caveats, because this move has real limits you have to respect. First, it only works in a regular taxable brokerage account. Inside an IRA or a 401k, none of this applies, because those accounts don't have capital gains withdrawals or just ordinary income. So this is purely a taxable account move. Second, and this is where precision matters, the gain you realize adds to your taxable income for the year. So if you harvest too much, you push your own income up over that 0% ceiling, and the gains above the line suddenly get taxed at 15%. You'd be shooting yourself in the foot. So the discipline is to calculate exactly how much room you have between your current taxable income and the top of the 0% bracket, and harvest only up to that line, not a dollar more. It takes a little arithmetic, or a good tax tool, or a CPA. And third, remember this competes for the same bracket space as a Roth conversion, which we'll cover in Move 5. You generally can't max out both a 0% harvest and a big conversion in the same year, because they both fill up your low brackets. So you have to choose which lever to pull each year. Precision and coordination are everything with this one. Bill and Carol check their income. They're comfortably under the $99,000 married ceiling this year. So they calculate exactly how much room they have left and sell just enough appreciated stock to fill it, paying zero tax and resetting their bases higher. A few $1,000s of future tax erased for free in one December afternoon. That's Move 1, done. Move 2 is bigger. Box 1, checked. Let me summarize who this fits, because that's the whole point of a checklist. If your income sits in that 0% zone, roughly under $50,000 single or $100,000 married in taxable income, This move is close to free money. You get a tax-free gain plus a permanent basis boost, saving you real dollars down the road when you eventually sell for real. For retirees in their low-income gap years, it's one of the best moves on this entire list. And it costs nothing but a little arithmetic. But if your income is higher and you're already over that ceiling, this one simply doesn't apply to you. Your gains would be taxed. So there's no free harvest to grab. And that's totally fine. That's exactly why this is a checklist and not a set of orders. You do the moves that fit your situation and skip the ones that don't. So if move 1 isn't for you, no problem. Skip right past it. But move 2, coming up next, is different for anyone over 73. Part of it isn't optional at all. In fact, ignoring it triggers one of the harshest penalties in the tax code. Let's make sure you never get caught by it. Move 2, your required minimum distribution, and a brilliant way to soften it. This one has 2 parts. First, if you're old enough, you must take a withdrawal from your retirement accounts or face a brutal penalty. Second, there's a charitable move that can make that forced withdrawal nearly painless on your taxes. Let's do the mandatory part first. The rule: once you hit age 73, the government forces you to start withdrawing from your traditional IRAs and 401ks each year. It's called a required minimum distribution, an RMD. If you were born in 1960 or later, your start age is 75. The government let you defer taxes for decades, and now it wants its cut. You can't leave it in there forever. And here's why you absolutely cannot forget this one. Why it's the one non-negotiable item on the whole list. If you fail to take your full required amount by December 31st, the penalty is genuinely savage. It's a 25% excise tax on whatever you were supposed to withdraw but didn't. Let that sink in. Not 25% of the earnings, 25% of the shortfall itself, as a pure penalty, on top of the regular income tax you'll still owe. Now, the good news is that this penalty was actually reduced recently. It used to be a brutal 50%, and it can drop to 10% if you catch and correct the mistake promptly within a couple of years. But even 10 or 25% is enormous. Picture a retiree who was supposed to take a $10,000 required distribution and simply forgot. They could owe $2,500 in penalty for nothing, just for missing a date. It's one of the harshest, most easily avoidable penalties in the entire tax code. So this is the one item on today's list that isn't a clever optional optimization. It's mandatory. And the cost of forgetting is severe. If you're 73 or older, before you do anything else on this list, confirm you've taken your full RMD. Your brokerage will calculate the exact number for you, often automatically. Just make sure it actually goes out the door before December 31st. So the first, non-negotiable task, if you're 73 or older, make sure you've taken your full RMD by December 31st. Your brokerage can calculate the exact amount for you. Just take it. This isn't optional or clever, it's mandatory. And the penalty for forgetting is one of the harshest in the whole tax code. Check this box first, before anything else. Now for the smart part. Here's where it gets clever. If you give to charity, instead of taking your RMD as cash, getting taxed on it, and then donating separately, you can send money directly from your IRA to a charity. It's called a qualified charitable distribution, a QCD. And it does something a normal donation can't. It keeps that money completely off your taxable income. The limits are genuinely generous, far more than most retirees will ever need to use. In 2026, you can direct up to $111,000 per person straight from your IRA to charity as a QCD, and for a married couple where both have IRAs, that's up to $222,000 combined. That limit is now indexed for inflation, so it creeps up each year. It was $105,000 back in 2024, and a flat $100,000 for years before that. And here's the key mechanic that makes it so valuable. That QCD amount counts towards satisfying your required minimum distribution, dollar for dollar. So if your RMD for the year is $20,000 and you QCD $15,000 to charity, you've satisfied $15,000 of your required withdrawal, and you only need to take the remaining $5,000 as normal taxable income. But the $15,000 that went to charity is excluded from your income entirely. You met your RMD obligation, A&D funded your charitable giving, and the portion you gave never got taxed at all. It never even appeared on your return as income. For a charitable retiree facing a required distribution they don't actually need to live on, this is very close to the perfect move. It turns a forced taxable withdrawal into a tax-free gift that also quietly lowers your Medicare premiums and Social Security taxes. That's why any advisor will tell you that if you're over 70 and a half and you give to charity. The QCD is almost always the single best way to do it. Why does excluded beat deducted? This is subtle, but it's the whole reason a QCD is so powerful. So let me make it clear. When you make a regular charitable donation, it's a deduction. And a deduction only helps you in two narrow ways. It only counts if you itemize instead of taking the standard deduction. And even then, it only reduces your taxable income after your adjusted gross income is already calculated. Your AGI, that headline income number, stays high. A QCD is completely different. It's an exclusion, which means the money moves straight from your IRA to the charity and never appears on your tax return as income at all. It's as if you never received it. And here's why that matters so much. A whole list of nasty things are tied to your adjusted gross income, not your taxable income. How much of your Social Security gets taxed? Your Medicare Part B and D premiums through something called IRMA. Your eligibility for various credits. By keeping the money out of your AGI entirely, a QCD can lower all of those at once. A regular donation, even if you itemize, does none of that because your AGI never drops. So excluding income from your return is genuinely, structurally more powerful than deducting an expense. For a charitable retiree over 70 and a half, this distinction can be worth thousands of dollars a year in reduced Medicare premiums and Social Security taxes, on top of the gift itself. It's the difference between the money never counting and the money counting and then being partly subtracted. One bonus: you can do QCDs starting at age 70 and a half, which is actually before RMDs even begin at 73. So in those gap years, you can give from your IRA, shrink the balance, and reduce your future required withdrawals before they ever start. If you're charitably inclined and over 70 and a half, the QCD is almost always the smartest way to give. Start early if you can. Bill is 73, so he has an RMD due. He was going to donate to his church anyway, so instead of taking the cash and getting taxed, he directs part of his RMD straight to the church as a QCD. It satisfies his required withdrawal, funds his giving, and keeps his taxable income down, which even trims his Medicare premium. One move, 3 wins. Box 2, checked. Move 3. Move 3, the standard deduction, and how to make sure you're getting the biggest deduction possible. Every year you get to subtract either a fixed standard deduction or your itemized deductions, whichever is bigger, from your income. The trick is knowing which one wins for you, and there's a clever technique to tip the scales in your favor. First, the 2026 numbers. The standard deduction is $32,200 for a married couple filing jointly, or $16,100 for a single filer. That's the amount you get to subtract automatically. No receipts, no tracking. For most people, this fixed amount beats adding up their itemized deductions. But for seniors, it gets even bigger. If you're 65 or older, you get more. There's an extra $1,650 per person on top for a married couple. And brand new for 2025 through 2028, there's a bonus senior deduction of $6,000 per person. These stack right on top of the standard deduction. So a qualifying older couple's deduction climbs dramatically. Add it all up for a 65-plus married couple where both spouses qualify. You start with the $32,200 base standard deduction. You add $3,300 for being over 65, $1,650 each. And you add the brand new senior bonus of $12,000, $6,000 each. That totals about $47,500 of deduction automatically, with 0 receipts and 0 tracking. Think about what that means. Nearly half of many retired couples' entire income is shielded from federal tax right off the top, before they do anything at all. If a couple lives on 60 or 70,000 a year, a huge chunk of it is simply never taxed. That new senior bonus deduction, worth up to $12,000 for a couple, is a genuinely big deal, and it's a limited time provision. It's on the books for tax years 2025 through 2028, and then it's scheduled to disappear unless extended. There's also an income phase out. It starts shrinking once your modified adjusted gross income exceeds 75,000 single or 150,000 married. But for the many retirees under those limits, this is real, substantial money for the next few years. So the first task of Move 3 is simply to make sure you're capturing every dollar of the standard deduction you're entitled to, including these senior stacks, because for most retirees, that giant standard deduction is the biggest tax break they'll get. Now, the technique bunching. Itemizing only beats the standard deduction if your itemized deductions, charitable gifts, medical, state taxes add up to more than that big number. In a normal year, most retirees can't clear it. So you cram 2 years' worth of charitable donations and deductible expenses into a single year, clearing the hurdle that year, then take the standard deduction the next year. Alternate and win both years. Picture it. Instead of giving $5,000 to charity every year and never clearing the hurdle, you give $10,000 every other year. In the giving year, your bunch deductions might exceed the standard deduction, so you itemize and win. In the off year, you take the big standard deduction. Over 2 years, you got more total deduction than giving evenly. Same generosity, better tax outcome. That's bunching. But here's the honest caveat, and it's important. Because the standard deduction is now so large, especially with those senior bonuses, clearing it by itemizing is harder than it used to be. For many retirees, even bunch deductions won't exceed $47,000. So be realistic, run the actual numbers before assuming bunching helps you. For a lot of people, the giant standard deduction simply wins, and that's fine. Don't force it. One nice bonus for 2026, even if you take the standard deduction and don't itemize at all, you can now deduct up to $2,000 of cash charitable giving as a married couple, $1,000 if single, right on top. A small above-the-line perk for the generous non-itemizer. Every bit helps. Bill and Carol run their numbers, find the standard deduction wins for them this year, and simply take it. Box 3, checked. Move 4. Move 4 is really 2 quick housekeeping tasks that each save money, topping off your tax-advantaged accounts before the deadline, and making sure you won't owe a penalty for underpaying your taxes. Both are easy to overlook, and both have year-end deadlines. Let's knock out both fast. First, top off. If you're still working part-time or have a health savings account, fund them to the max before the deadline. And SHA in 2026 lets you contribute up to $4,400 for self-only coverage, or $8,750 for a family, plus an extra $1,000 if you're 55 or older. The SHA is the most tax-advantaged account there as contributions, growth, and medical withdrawals, all tax-free. Fill it if you can. Watch the deadlines, because they differ. Contributions to a workplace 401k must be made by December 31st. But IRA and SA contributions can be made all the way up to the April tax deadline of next year. So the 401k is the urgent one before the ball drops. The others give you a few extra months. Know which clock you're racing. Don't miss the December one. Now the clever part, the withholding check. The IRS want you to pay your taxes throughout the year, not all at once in April. If you underpaid during the year, they hit you with an underpayment penalty. Retirees often trip on this because withholding on pensions and IRA withdrawals can be too low. But there's a slick year-end fix. First, the safe harbor. You avoid the penalty entirely if you've paid in at least 90% of this year's tax, or 100% of last year's tax, 110% if your income is over $150,000. Hit either target in your penalty proof, no matter what you owe in April. So check, have you paid in enough by those rules? If not, here's the trick. Here's the beautiful loophole that most people have never heard of, and it can save you from a penalty at the last minute. Normally, the heirs want your taxes paid in steadily throughout the year, quarter by quarter. So if you make one big catch-up payment in December, it still looks late for the earlier quarters, and you'd owe a penalty for having underpaid all year. But in this is the magic money withheld from an IRA distribution is treated by the heirs as if it was paid evenly across the entire year, regardless of when you actually do it. Withholding is special that way. So here's the fix. If you get to December and realize you've underpaid your taxes for the year and are staring at a penalty, you can take a distribution from your IRA and have a large chunk of it withheld for federal taxes. Because it's withholding, the IRS pretends it was spread evenly across all 4 quarters, which retroactively cures your underpayment for the whole year and erases the penalty. It's a genuine get-out-of-jail-free card for underwithholding, available right up until December 31st. You do have to have an IRA to pull from, and the distribution itself is taxable income, but the withheld portion goes straight to covering your tax bill and killing the penalty. For a retiree who realizes in December that their pension or Social Security withholding was too low all year, this trick is a lifesaver. It's one of the most useful obscure tricks in retirement tax planning. Carol realizes their withholding fell short this year. So in late December, she takes a small IRA distribution with a chunk withheld for taxes, instantly bringing them up to the safe harbor line and erasing any underpayment penalty. She also maxes their SAW. 2 quiet housekeeping moves, a penalty dodged, and more money in a tax-free account. Box 4, checked, 1 move left, and it's a big long-term one. Move 5, the year-end Roth conversion. This is the most powerful long-term move on the list, and it has a hard December 31st deadline. The idea in a low-income year, you deliberately move money from your traditional IRA into a Roth, pay a little tax now at a low rate, and make that money tax-free forever after. Timing is everything. Here's the mechanic. Money in a traditional IRA is fully taxable when you eventually withdraw it. Money in a Roth is tax-free forever. A conversion moves money from traditional to Roth, and you pay ordinary income tax on the amount converted this year. The trick is to do it when your tax rate is unusually low. So that toll is small, then enjoy tax-free growth and withdrawals for the rest of your life. When is your rate lowest? Often the gap years after you retire, but before Social Security and required withdrawals kick in and pile up your income. In those years, your taxable income can dip surprisingly low. That's the golden window to convert, filling up the low tax brackets cheaply while they're empty. Bill and Carol are in exactly that window right now, before their RMDs and full benefits start. The strategy is precise. You convert just enough to fill up a low tax bracket, but not so much that you spill over into the next higher one. Think of your tax brackets as buckets that fill from the bottom. In a low-income gap year, your lower buckets, the 10 and 12 and 22% brackets, have lots of empty room in them. A Roth conversion lets you deliberately pour money into those cheap, half-empty buckets, paying tax at those low rates, rather than leaving that IRA money to be forced out later at potentially higher rates when RMDs and Social Security have filled your income up. So you convert an amount that tops off, say the 12 or 22% bracket, but stop before you tip into the next one. Then you repeat it the next gap year and the next. Do this deliberately over several low-income years before your RMDs begin, and you can shift a very large chunk of your traditional IRA into tax-free Roth space at bargain tax rates. And there's a double benefit. Every dollar you move out of the traditional IRA is a dollar that won't be part of your future required minimum distributions. So you're also shrinking those forced withdrawals and the taxes they'll trigger down the road. It's a patient, multi-year game played a little bit each December and for the right person in the right gap years. It can save 6 figures in lifetime taxes, but it has to be done thoughtfully, bracket by bracket, year by year. And here's why it's on this year-end list. Unlike an IRA contribution, which you can make until April, a Roth conversion must be completed by December 31st to count for this year. There's no grace period, no extension. If this year was a low-income year for you, The window to capture it slams shut at midnight on the 31st. Once it's gone, that low-rate year is gone. Act before then. Now the crucial caveat, because a Roth conversion is powerful, but it has real ripple effects you must watch. A conversion adds to your taxable income this year. That's the whole point. You're deliberately realizing income at a low rate, but that extra income doesn't just affect your income tax. It can push you into higher Medicare premium territory through IRMA, which uses your income from 2 years ago to set your premiums. It can reduce or eliminate Affordable Care Act health insurance subsidies if you're not yet on Medicare, which can be a huge hidden cost. And it can cause more of your Social Security benefits to become taxable. So a conversion that looks great on income taxes alone can trigger thousands in these secondary costs if you're not careful. That's why you convert deliberately, watching all of those thresholds, not just your tax bracket. And here's a critical interaction to notice: this move competes directly with Move 1, the 0% capital gains harvest for the same low bracket room. Both strategies work by filling up your empty low brackets, but you only have so much room before you tip into higher rates or trip those thresholds. So in any given year, you generally have to choose: do I use my low bracket room to harvest gains at 0% or to convert to a Roth cheaply? You usually can't do both to the max. That's why year-end tax planning is really about coordinating all these levers together, ideally with a CPA who can see the whole board rather than pulling any single one in isolation. They all draw from the same limited pool of low bracket space. Bill and Carol, in their gap years, decide to convert a measured amount from their traditional IRA to a Roth, enough to fill a low bracket, but not so much that it spikes their Medicare premiums or overtaxes their situation. They pay a small tax bill now and lock in tax-free growth for decades. It's a small sacrifice this year for a big win later. Box 5, checked. That's the whole checklist. So there's the full year-end checklist, run right alongside Bill and Carol, harvest gains at 0%, take the RMD and use a QCD, beat the standard deduction or take the big one, top off accounts and fix withholding, and Roth convert in a low-income year. 5 moves, most due by December 31st, quietly saving them thousands. Now let's make sure you know which ones fit you. Quick Fit Guide. Gain harvesting only if your income is under the 0% ceiling. QCD only if you're 70.5 plus and give to charity. Bunching only if your itemized deductions can actually clear that big standard deduction. Withholding fix only if you underpaid. Roth conversion best in a genuinely low-income year. Do the ones that fit you, skip the rest. That's the whole art of it. Here's the whole thing in one line every December. Run these 5 moves, do the ones that fit your situation, and get them done before the ball drops, because most of these doors close on December 31st. A single afternoon of year-end housekeeping can quietly save you thousands on next April's tax bill. That's the highest hourly rate you'll ever earn. Put it on your calendar. If this checklist showed you money you'd have left on the table, like the video so it reaches the next retiree before December 31st. Save it and run it every year. And tell me which of these 5 actually applies to you this year. The 0% harvest, the QCD, the conversion? Curious which one is the big win for you. And if a CPA could size these for you, this is the season to call. And tomorrow, the natural sequel, the January reset. The money moves to make in the first few weeks of the new year while everyone else is still recovering from December, resetting your contributions, your withholding, and your plan for a fresh tax year. We closed out the old year today. We open the new one tomorrow. See you tomorrow.